Hi, and welcome back to Pay Down Debt Solutions. I'm Jen, and on this channel, we teach you how to get out of debt through velocity banking. Today, I want to talk about the debt cycle and breaking free from the debt cycle. It is no guess why Americans are in so much debt with things like lifestyle creep and inflation, but the average household debt is $18.59 trillion, and that is up from 2019. So there's a lot of debt that we are in as Americans. And as a matter of fact, there are corporations that will pay advertisers big dollars for leads for health insurance and those that are in debt. So we are bombarded by ads out there trying to get you guys to go to these debt repayment companies and for banks that want you to get into consolidation loans. And we are going to learn how to break free from that cycle without you guys getting extra loans, because we do things through lines of credit and things you already have in your pocket, because we don't need to be paying any extra money to these banks. They've got enough of our money, right? They have enough of our money, so let's break free and let's do things a little different. So we're going to talk about the debt cycle today. We're going to talk about the mindset around debt, and we're going to talk about ways you can get out of it and how to use velocity banking to do that. Again, my name is Jen. Dan and I run this channel. Dan is my husband. We were in a lot of debt at one point in our life. We even considered bankruptcy. We had thought about debt repayment companies until we learned velocity banking. So our mission is to bring this to you at a faster and cheaper way, right? By doing it through what you learn up here and the tools you already have in your pocket, all right? So let's talk about the debt cycle and how to break the debt cycle without going to some kind of a consolidation loan, because you don't have to do that, you guys. You don't. So here's the debt cycle, right? Pretty simple here. We know we have monthly expenses. Who doesn't, right? We all have monthly expenses. So those monthly expenses, it's a lack of spending awareness sometimes. It can be lifestyle creep or unexpected expenses that continuously cause us to have more expenses. Inflation and income that doesn't keep up with the cost of living, because we all know that we get raises out there and they're less than 3%. I know that when I was in banking and in management at banking, we were told that we could get up to a 3% raise. Do you think I gave out a 3% raise? Do you think I was allowed to get out up or allowed to give out a 3% raise? I was not. So even if your boss or your manager wants to give you the max raise, they may not be able to, because corporations, they want to keep all the money that they have, don't they? Right? We all do. I get it, but it certainly doesn't help us as Americans, does it? So we have our monthly expenses, all right? And that leads to a lot of times, because of lifestyle creep, not getting enough of a raise, it just expenses in general, things that come up that are unexpected. We end up getting credit cards and loans. And sometimes those are those debt repayment companies, right? That want to take all your money from you and help you negotiate rates, right? So then they earn 20 to 25% from you, just like those advertisers out there that these companies are paying $30 to $45 for you to click a button and make a phone call, okay? To click a button, make a phone call. They're paying advertisers $30 to $45 per call. Think about that, you guys. There's a lot of money in these industries, all right? And so you end up with credit cards, right? These types of things you get are credit cards. Sometimes they're refinances. Don't do that. They're personal loans. You guys all that know me know how I feel about refinances. Personal loans, sometimes payday loans, and these are all used to quote unquote make up the difference. We know that Americans are spending more and more money on credit cards, right? They're using credit cards to pay for groceries. Now, I'm not talking about the velocity banking way that we do it. I'm talking about they don't have any extra money, so they're putting it on the credit card to make up the gap, right? Okay, so there is a difference there. Now, of course, this leads to, when you have credit cards and loans, and then you continuously get more and more and more of them, right? It leads to more debt, all right? And that more debt, again, it's repayment with interest charged, right? Become even greater expenses and further depletes your resources, right? So the more debt we take on without solving our debt problem, see, these repayment companies, they don't solve your debt problem. They don't solve it. They don't teach you something different. So what we teach on this channel is to change the way you do your banking. And it's all in a very simple change that can change everything for you going forward. Your goal in life is to leave something to those you love, maybe. That might be a goal. Or maybe you just want to retire with some kind of a nest egg where you don't have to worry about going to work. Maybe that is your goal. And you can't do that if you're in a continuous debt cycle. Somehow we have to break out. And velocity banking is one of the most effective ways I've ever seen to do so. All right. And we're going to talk about a student scenario here today for you. And I am doing this through a home equity line of credit. Now, some of you out there poo-poo the home equity line of credit, or you say, I can't get a home equity line of credit, or you really can't because maybe you rent, right? So you can go and look at personal lines of credit instead. Now, something that I want to talk to you guys about too. You may be sitting in a situation where you have a bad credit or one of you has poor credit, so you don't think you can get a home equity line of credit. And I can tell you in this situation here, that was the case. One of them had good credit, one of them did not have good credit. The one that had the good credit was not the breadwinner. The breadwinner had better credit. And guess what? They were still able to get a home equity line of credit. You guys may find that you are surprised when you go to entertain getting a home equity line of credit. I also have another student of ours who makes a lot of money. She does not have good credit. Her husband has good credit. She is the major breadwinner of the family. And they also were able to get a home equity line of credit. Okay. So you guys might be surprised. So don't discount it, and don't discount considering your debt on a home equity line of credit when you run it as I suggest. Okay. So we talked about the debt cycle. Now let's talk about the solution. What is the solution? Well, if you change where you put your money, you can then change the amount you owe. All right. So, because if you do this, you're going to increase your cash flow. Now, some of you are scratching your head wondering how that happens. And that's what we're going to show you right here. So, I have a checking account, just as you have a checking account. You also more than likely have a credit card or a house, or maybe you have a personal line that you can use. All right. These are tools. Your house is a tool. It's a tool in the form of a home equity line of credit. Your credit card is a tool because it is a line of credit and it is purchasing power, just as a home equity line is, just as a personal line of credit is. Like my stick figure there, guys. I think I'm funny. Anyway, so we also know that we typically have a direct deposit of some sort or income that we get. Maybe it's in the form of a check, maybe it's cash, right? And so typically what you do is you take your direct deposit and you're going to get it, or your check or whatever, and you're going to stick it in that checking account, right? So that's what you're going to do. So what I suggest you do is not this. It is instead going to be this or this or this, depending on what you have available to you to use. So then you might ask, well, why would we want to do that? Well, the reason is velocity banking. The way that we run velocity banking strategies is by putting all of our income into a debt tool, and we run all of our expenses out of that debt tool. So what does that mean and what does that look like? Well, you have your money, right? Here's your money. Don't care how you get it. Doesn't matter if it's a check, if it's a direct deposit, or if it's cash, makes no difference. You are going to then put it into your line of credit, whatever it may be, whether it's a credit card, whether it's a home equity line of credit or a personal line of credit, makes no difference. And that line of credit, then you are going to do your best to absorb as many of those debts that you have currently as you can. So that would mean you would take maybe and put your car loan in there if your line's big enough. You might put all of your credit cards in there if your line is big enough. You might put store cards and your student loans if your line is big enough, right? So then what does that look like? Okay, that's great. I put all of my money into this line of credit, Jen, but I have bills. So now what do? I have bills. How am I going to pay those bills? Well, quite simply, you are going to use that line of credit then to pay all of those utilities, living expenses, or the unexpected what ifs. That's what you're going to do when you run a velocity banking strategy. So what does this do for you? It increases your cash flow, right? Because what happens to these payments? Once those payments are absorbed by this line of credit, you no longer owe those payments. So in my situation here, right, in my HELOC situation here with this couple, if they were to put all of their debts here into that line of credit, those payments then come back to them as cash flow. All right. Now, and not only that, that home equity line of credit payment, they don't owe that either. Well, how is that? Well, because of this. Home equity lines of credit are, and credit cards and all lines of credit, when you put your income into them, you end up satisfying that payment unless your income is less than the payment, which typically wouldn't be the case. Okay. So that being said, that means that if this home equity, and a lot of times home equity lines of credit run at interest only. Well, interest only doesn't obviously work your debt down for you, does it? So you never want to pay just interest only because you'll have a debt then until the day you die, right? You just would. So that's not how we do things though, right? But a lot of times home equity lines of credit will be interest only. And if they had a home equity line of credit and they took out, let's say $33,101, then at interest only, it would cost them about $257 or so a month in a payment. All right. Now, if they then had a home equity line of credit that was at interest and 1% payback, which we do want to pay back, right? Because we want to work that balance down. If they did this and they ran it traditionally, and they paid interest in 1%, that would be about, I don't know, I think it's 500, what do my notes say? About $589, $590, okay, would be the interest only. I'm sorry, the interest in 1%. But $590, isn't that less than the $1,248 that they're paying right now? Isn't it? But guess what? When you run Velocity Banking Strategy, you don't pay that either. You don't pay this. You don't pay the 257, and you don't pay the 590 either, because that income that you're going to put in is going to satisfy the payment. So that all goes back into the line and works your balance down faster. All right, so let's talk about their situation here. Let's go review their debts, and then I'm going to show you exactly how this would work. All right, so Velocity Banking in Action has us at an income of $5,840. It has us with total expenses of $5610. So the income here is $5840. Their total expenses that they're currently paying is $5610, which means their cash flow is $230. At least they have money at the end of the month, but they came to us because they were sick of being broke, and they came across our channel and other Velocity Banking channels, and they said, we know we can do this different by understanding a little bit about Velocity Banking, but they wanted help in determining how to do that. Should they do it through credit cards? Should they do it through a personal line of credit? Like, what should they do? Well, I'm always going to suggest to you, if you can do it, a home equity line of credit, because that is the cheapest way you're going to do it, always. And the fastest, because you can put every cent of your income into it. All right. And we'll explain that and show that a little bit later here. So here they are with their mortgage at $1,196. So they owe $1,196 a month on their mortgage. Their car one here, we're going to call it, is $621. And the total of those are $1,817. So those two debts there cost them $1,817 a month. So then they have these debts here that they really wanted to get rid of, or they actually didn't know which debts they should get rid of. But in coming to us and working with us, we showed them what would make the most sense for them. Okay. So we have car two, we'll call it, and its balance is $11,668. They're paying $816 a month. This is a heavy payment, and that's why we put it into this home equity. Okay. So $1,816 is a big payment. It's at a 7.2% interest rate. They have left on that about 1.4 years left on that. So it's been, I think it was a 5-year loan, I think. I'd have to run the math on it again. Anyway, so they would, to finish this out, they would owe $642. $642 is what they would owe. Then they have a BOA card, one of my favorite cards, is $4,360 is what they owe. The payment on that is $90. It's at a 22% interest rate. It would take them 10 years and 1 month to term that out traditionally, and it would cost them $6,492 of debt interest, okay? So then they have a Gap card here. $790 is the balance on that. A $30 payment on that as well, 33%, because we all know that those store cards eat you alive. So it's at 33%. It would take them 4 years to pay it at $30 a payment, and it would cost them $634. Then they have 2 student loans. Okay, there's 2 student loans that they have, and they are 15 years in. They have about 5 years to go. The first loan here is $12,161 is what's left on it. The payment on it is $232. The second loan there is $4,122. $80 is the payment on that. So that is at 6.2%. Like I said, they're both about 5 years left on them. The $12,000 balance is $2,725 is what they would owe in debt interest to continue to pay that off to term. And then this one here, it would cost $682 to finish that out to term. So what does that mean? That means that right now they have $33,101 in debt balances, okay? They have payments on this debt is $1,248. Imagine if they could get that back and put it in their pocket, or get that back and work down their debt with it. Imagine that, right? Well, we don't have to imagine it because we're going to do it. We're going to do it. All right. So then that means that we have $11,175 is what they would owe if they term this out traditionally. But we don't term things out traditionally here on this channel anymore. We learn a different way. We learn to do exactly what I show you here. And so we're going to work this out and find out, what does velocity banking do that continuing in the traditional banking system can't. So let's look at that. Let's look and see what that's going to look like when we run the strategy. Okay, so I'm back with numbers to look at for you. So as you recall, we have 33,101 is our balance. Okay, those are the balances that they are going to owe. And then we have a total in payments here of $1,248. Now, we are going to be able to take care of all of this debt because they were able to get a home equity line of credit for $39,600. And again, one of them did not have good credit. So one of them was not going to be on the home equity line of credit. The other was, and they still, even though the breadwinner was not on that line of credit, they were still able to do it. Again, another situation of mine that I just told you guys about. Wife makes a lot of money, and she could not be on the home equity line of credit. They didn't think they were going to qualify. They didn't think they were going to qualify, nor did they think that they were going to be able to, get the line of credit because of, her credit score. So they were worried about that. They didn't think that he could do it alone because he just didn't make enough, but you guys would be surprised, okay? They did do it through a credit union. So I want you guys, even if you think that you may not be able to, have the conversation with your bank or your lender, because you might be surprised. They may encourage you. They may not. They may discourage you if they think it really won't work, but you never know. So I think it's always worth having the conversation. Just like it's worth having a conversation to ask your credit card issuer to send you convenience checks, or to see if you have the ability to do a balance transfer, or if they have any offers out there. There's no sense in not trying, right? There's no sense in not doing it. So when we take a look at this, we're going to see how it works. So we're taking that home equity line of credit for $39,600, okay? And we are taking the $33,101 and we are going to put that into our line of credit. So now what have I done? I have taken all of this debt here that they have, okay? That would take them 10 years, the longest, 1.4 at the shortest for the car loan, but basically between 5 and 4 years if you're going to average it out, right? It's going to take 4 or 5 years to take care of all of this. So what velocity banking does that traditional banking doesn't do is gives you purchasing power, because when you put that income, okay, when they put this income into this line of credit, it works down their balances because this comes back to them, right? It comes back. So what does this look like? Well, it looks like this. So we have $33,101. We subtract out our income. Now, I can put my entire, or they can put their entire income in, because when you work with home equity lines of credit or personal lines of credit, you typically have the ability for that to be connected to your checking account. So what that means is you can move money as needed into your checking account to cover your expenses. All right. So you can cover your expenses right out of the checking account because money moves. Now, it can do it in the form of an overdraft protection, which a lot of the credit unions will offer you overdraft lines. So they sweep money without a fee. If there's a fee, don't allow that to happen. You guys go in and manually move it. It's not that hard. Trust me, I did it for years. So it's not that hard to do. All right. So that means that you're going to be running things then. You can run them out of your checking account, knowing that that home equity is connected to the checking and you just transfer money and it's instantaneous, guys. You don't have any waiting time. Okay. If your checking account's in the same bank. So a lot of times you can do it that way. Now, if you're me, I'm going to still run everything on a credit card because I'm going to get those darn points. So if you're me, you're going to do that. And then you're just going to pay that credit card when it comes due. You're going to pay it off entirely so you don't carry a balance, right? So that is up to you how you choose to do that. But that is how lines of credit work. They sweep into the checking or you move them into the checking and then you make your payments from there. So we have our income that comes in. It drops us to 27 to 61. Okay, so immediately my average daily balance is dropped, right? So what makes this work is the average daily balance gives you interest debt relief, because when you put a chunk into that line of credit, a chunk payment into that line of credit, it immediately lowers your balance. Now, you don't have to micropay there because banks don't work like that with lines of credit. I have not seen that happen. If you guys have, comment, but I have not ever seen that happen. So you can put all of your income in. There is no fear there. You put all of your income in, you run all of your expenses out of it. Okay, so all of that comes out. Now, I've had people ask me too, well, what if my mortgage payment, I get paid, money goes into that home equity line of credit, then my mortgage payment comes out 4 days later. Is there a point in putting it into the home equity? Should I just leave it in my checking? Yes, put it into that home equity line of credit, because why? Why? It's the average daily balance, right? That average daily balance then, boom, is lowered by that big mortgage payment. So yes, you want to do that. Now, you can ask and see if your mortgage company will move your payment. You could always ask that. That is something that I always ask. There is no harm in asking, right? There's no harm in that. So you could also move it. That's another possibility. All right, so back to this. So we've got our income of 5840 goes in, drops us to 27 to 61. Then our expenses come out. Well, our expenses have changed, right? They were 5610. They are now 4362. Well, how did I get that? Let's just do it, right? So I've got 5610, right? And I subtract out the 1248. Okay, what does that give me? That gives me the 4362. Okay, 4362. Because I took care of all these debts. They're now enveloped or absorbed or eaten by that home equity line of credit. All right. So we know that the expenses have to still come out, and we know that our interest comes out. Well, how do we figure out what our interest is going to be? If we want to know how long this is going to take us, and we want to manually do the math to calculate it out to its end date per se, right? You can do the math and figure out how much the interest is. Well, how do you do that? Well, we know that our line of credit is at 9.3%. So what you're going to do is you're going to take your balance, your high balance, right? The 3301, you take 33,101, okay? And you're going to add to it your low balance, the 27,260, whoops, I put 267. So it's going to be 33,101 plus 27,261, Jen. That equals 60,362, but we divide that by 2, right, to get the average. So 30,181. Now, the average we then multiply by 0.09, what is it, 3? Yes, 0.093, because it is, that's our interest rate, right? We multiply by the interest rate, and that equals 2,806. We then divide that by 12 because we only need 1 month of that, right? We only need 1 month. So that gives us the 233. All right, so 1 month of it is 233. And we only need 1 month because we know month over month over month, because we are working this down. We're putting all of our income in, and the cash flow is going back into it to work it down. This is why velocity banking works right here. And you still have purchasing power, okay? So every month it's going to go down, and as you can see, it does, right? So and after we put our income in, we drop to 27 261. That means our expenses have to come back into the line of credit. Our interest comes back into the line of credit, and it brings us back up to 31,856. Well, is this working? How do we know? Because the 31,856 is less than the 33,101 that we started with, right? It's working. Again, income comes in the following month, drops us to 26,016. 26,016, I just carried it up here. Then you add in your expenses, you add in your interest. Oh, wait a minute. 233. Let me check that here, guys. This shouldn't be 244. This should be 224. My bad. Okay, so this is 224. See, and that's why you do your checks right there. That's why you do your checks. So that was my bad. All right, so this is 224. So if we add that up, it should still, let's see, 6, 7, 8, 9, 10. Yep, that still works. Okay, so yeah, it was just the interest error. I carried it over wrong. All right, so 233 drops to 224, and it continuously drops, right? Because we're dropping our balances. We're dropping our balances, so our interest drops. Average daily balance right here, the average daily balance. Okay, so that means that we're at 30,602, right? 30,602 after all of those expenses come back in, the interest and our living expenses. Is this 30,602 less than the 31,856? It is, right? So we know this is going to work, okay? And I know it's going to work because we have a handy dandy tool that we built that tells me that this works, and it makes my math lickety split like that, so I don't, transpose numbers or carry them over wrong. So anyway, what does that look like then? Okay, so when they run a velocity banking strategy, that means that it takes them 21 months, okay, 21 months, and it costs them $2,772 in interest. $2,772 in interest. What did it cost over here? 11,000. Oops, I'm throwing stuff around. 11,175. So less than 2 years, right around 4 or 5-ish years, or 10 years if you're going to spend this year, if you're going to keep it at $90, that minimum payment, right? This is why we velocity bank, you guys. It makes so much sense. I told you this saved our rear ends. Dan and I, when we expanded our businesses too quickly and got in way over our head, we had so many payments going on. We didn't know what we were going to do. Guess what we did? We did this. This works. We are living proof that it works. I want to see you guys succeed. I want to see you try this. It's not hard. It's not overwhelming. It may look like it at first, okay? And again, we've got our course coming out and our app that goes with it. You guys can do this lickety split, easy peasy lemon squeezy, right? Super simple. Now, if you want one-on-one coaching, we offer that for you. We will do this plan. We will give you a plan and set it for you. We will record the call and give you that call. So you can do that too if you would like. Or you can watch this channel and learn. The math isn't hard, right? When you don't carry numbers over wrong. I mean, that's helpful, right? Anyway, I hope you guys learned something today. I'm really trying to break this down and make it super simple for you so you understand, number one, the power of velocity banking, the power of using lines, and stop using loans. Out there, when you're in that debt cycle, and we are all in a debt cycle, right? We know that because there's $18.59 trillion in household debt right now. That's a lot of debt. That's why you guys are targeted. I'm targeted. We're all targeted because we all need medical insurance and we're all in debt, right? And those are the reasons why those marketers are targeting you, why they want you to tap buttons and get phone calls, because they're getting paid every time that you do that, all right? But do something different. Don't do that. Solve the problem yourself on your own because you can. You don't need them. You don't need debt repayment companies. You don't need to file for bankruptcy. You can do this. I promise you that. Have a great day, guys. I'll see you soon.